This next one, Art, is a little bit more. It was a little bit lengthier, so I may have a little fill in. It says, I had the opportunity to buy my office suite instead of paying a monthly rental. I own my home free and clear. Would you suggest financing the purchase like a commercial loan or take equity out of my home? What are the pros and cons with that?
Yeah, that's a good question. And you know, that brings up a couple of issues that you would want to think about. You know, when this person was asking about buying an office suite, I believe what the intent there was buying a lot of folks may not realize this. Some office buildings are actual condominiums, just like a residential condominium building where you can own a unit within that building. Well, some office buildings are the same way. They're actually set up with a legal ownership of a condominium. And so you can buy an individual condominium unit in an office building. So that's what this person, I think, is referring to. And so then you've got a couple of choices. Certainly with respect to the actual office condominium unit, you can simply get a loan, a purchase money loan that's going to be secured by that unit. Now that's going to put you into the commercial loan category. That can be a little tricky. Commercial loans, generally speaking, and I've done a few. I can't say I do them all the time, but I have a pretty good idea of the basics of that sector. With a commercial office, a commercial loan for an office condominium unit, you can expect a couple of things. You're probably going to be looking at a little bit higher rate than a residential mortgage. The requirements in terms of documentation and things like the appraisal are going to be a little more expensive and higher cost. And the terms, you can get 30-year financing. A lot of times with commercial lending, the terms can be a little bit shorter, like 25 years, and oftentimes they can have a hybrid ARM feature where the rate's fixed for 3 or 5 or 7 years, and then it converts to an adjustable rate loan. And then with this kind of deal too, with commercial loans, oftentimes you're going to get a better deal if the loan amount's bigger. When you're talking about an office condominium unit or suite, that's usually a pretty modest price for that unit, probably in the several hundred thousand, maybe 500,000 or so. That's actually considered a pretty small loan amount in the commercial lending world, and generally you're going to be looking at a bit of a premium on the rate just because of that. Where I think the opportunity for this person is to use that free and clear residential home that they have, and instead utilize that equity. So what you're going to be doing is transferring that equity from your home that you live in to this office condominium unit you want to buy. The benefits to that are a couple things. One is you're going to get a better rate on the home, the loan being made on the home that you're already living in, especially if the home has got a pretty decent value to it. And if the amount you need to complete the office condo unit purchase is relatively modest, the loan to value that you're going to be dealing with on the refinance of your primary home is going to be relatively low. In particular, if it's below 60% loan to value, you're going to be able to optimize the rate you can get on that cash out refi of your primary home. Certainly, it's going to be a better rate than a commercial loan on an office condominium unit. Secondarily, and I think almost in some respects, this is an even bigger benefit beyond just getting a better rate for the financing. You're going to be able to negotiate a better deal on the purchase of the office condominium unit because you can basically negotiate that it's going to be a cash purchase. It's not going to be contingent upon getting a purchase money loan secured by that commercial condominium unit. So as a consequence, you're probably going to be able to overall end up with better terms on rate and payment, refinancing your primary home for the cash out, then negotiate an all cash purchase of that office condominium unit. That'll probably help you a little bit on negotiating what the price is going to be without having the contingency of having to get a commercial loan to complete the purchase. And of course, if you do the refi first, or if you get that underway even before you start negotiating that purchase of the commercial building or commercial unit, you can then negotiate a much quicker escrow period if you've already got that refi done, you've got the money in hand. So again, that can further help you in terms of negotiating a better price for that unit. So with that kind of scenario, that would be my take. Of course, yes, full disclosure, I'm a commercial real estate residential mortgage broker. I do I do primarily residential loans. So you might think, well, I'm a little biased to steer this particular person to going that direction, but I still think overall, objectively, it's going to give you more benefit by doing it that way than getting that commercial purchase money loan on that individual unit.
Well, I was curious, Art, when you said that is, you get a better rate. I was looking at your current loan amounts or loan rates on your homepage, and it's like so if I just go get a HELOC, not the fixed rate HELOC, but if I just get a HELOC, that's under 7%. Will a commercial loan compare with that, or is it going to be higher? Like you said, I'm going to pay a premium because in the world of commercial loans, this is kind of a little loan, so it's kind of a higher risk, I guess. So I'd pay a higher fee.
Well, yeah, exactly. I mean, the rate you're going to get on an office on a commercial loan for an office condominium unit is probably going to be more comparable to a HELOC rate. And of course, remember, in terms of this particular question, taking equity out of my current free and clear home, a lot of folks would look at, if they're in that position, they'll come to us and say, and I've had this happen actually multiple times recently. They'll come to me and say, well, I own this property free and clear. I want to access the equity. I want to get a HELOC. And I'll, of course, respond to that and provide them the numbers, but I'm always quick to say, well, wait a minute, understand that when you have that free and clear home, you've got multiple options here. You don't have to take that money out in the form of a HELOC. You might want to consider just getting a first mortgage instead of a HELOC. And they're going to say, well, why would I do that? I want to use it and reuse it and, draw against it, pay it down, draw on it again. Yeah, there is that flexibility. The trade-off, though, is more or higher rate. In this case, this particular scenario, this person has a specific need. They have a fixed amount of money they're trying to access to then move it over here to this other transaction and buy this commercial condominium unit. So that's, in my mind, less reliant than on the need to draw against this loan instrument after you pay it down in future years. You have a specific need, specific amount of money, you want to complete this specific purchase, and you're done. Well, with that being the backdrop, you're almost always going to be better off refinancing with a new fixed term, fixed rate refinance loan, not the HELOC, if for no other reason the rate's better. Again, we could probably do one of these at right around $599, especially if you're under 60 LTV on that residential refi purchase or refinance cash out, if you've got a good credit score. So a HELOC is going to be probably high 6s to 7s. Why would you take that higher rate when in reality you aren't demonstrating that you're going to have a need to keep going back and accessing that loan instrument over and over again? You've got a specific need. Once you close that purchase, you don't need the money anymore. So in my mind, you're better off going with that first mortgage. Forget about the HELOC. Of course, every case is different, but in a lot of cases, that just makes more sense.
I mean, that's a benefit of working with someone like yourself, Art, is the fact that you can look at it from so many different angles and so many different examples of what you've done in the past to help coach or guide, if you will, at least present the scenarios and find out exactly what they need. And it sounds like this one is, hey, a first is much better than the HELOC for those reasons. It's a very specific reason.
Yep.
And the rates are better. So that's a great answer. Thank you.